it's the economy. The rupee is once again close to testing 83 rupees per dollar. Although recent Indian data point to an actually strengthening of our macros. The consumer price inflation in November was down 40 basis points below consensus estimates. It came in at 5.88, and importantly, it was below that 6% mark, hence in the comfort zone of the MPC and the RBI. And last week's trade data showed that the November trade deficit has fallen quite sharply from the October levels, both on the goods and services front and the goods and services front. The culprit for the weakening rupee is the strong wave of risk-off globally after 4 central banks last week raised rates and said they will continue to do so till inflation and the labour markets show a downturn. To assess the rates and exchange rate markets in 2023, we have with us Mitul Kotecha of TD Securities and Upasna Bhardwaj, the Economist from Kotak Mahindra Bank. Mitul and Upasna, thank you very much indeed for joining me. Well, Mitul, what do you make of the rupee? Have the macros now definitely given the rupee a bottom?
I think, as you mentioned, the fundamentals have certainly improved. When you look at the external deficit on the trade front, lower oil prices clearly are helping on that front. At the same time, some of the economic momentum is showing more signs of life as well. Inflation has come off more than expected, as we saw in the recent CPI report, although core inflation is still fairly sticky. So fundamentally, this is supportive for the rupee. But as you mentioned, I think we have still an environment where central banks globally, and as we heard last week from various central banks, who have maintained a pretty hawkish stance on policy. But again, look, the rupee has underperformed other currencies, other emerging market currencies. We think that is in part because it is a slightly overvalued currencies, and there is a preference for the rupee to probably depreciate as well to maintain some competitiveness. So we see upside still fairly limited in the near term.
Okay. I'll come back and squabble over that a little more, Mitul. Let me get Upasna in first to parse the trade data. Upasna, the trade data, if you looked at goods and services, the deficit is only $11 billion compared to $14.3 billion in October. Likewise, trade deficit, $23 billion compared to 26 and change in October. Do you think that the worst is behind us in trade deficit and we will start hearing people like you lowering the current account deficit estimates?
Absolutely, Lata. I think the trade deficit numbers, wherein we were expecting at some point that the lagged impact of lower commodity prices will begin to show in the import numbers, has started to show now. Hopefully, this will continue, especially with the crude oil prices, being well behaved as of now. So in that context, I think going ahead, we are looking at an average trade deficit number in the subsequent 4 months to be around $21 billion, which will obviously bring the whole of the year trade deficit and the current account deficit at a much more benign levels than compared to what we were expecting earlier.
You have got new numbers? I mean, were you working with 3.5? Is it now 3.3% of GDP? What's the current account deficit estimate?
Yes, so current account deficit, we were earlier, of course, our overall average crude oil price for the full year was about 105. Then we were at 3.9%. But now I think we will be closer to 3.2 to 3.3% if the crude oil prices were to persist in the current range now for the next few months.
Okay. Just one more question before I go to Mitul again. What about the balance of payments deficit? This 3% deficit is not all that ugly if we have enough foreigners investing. They were. And again, now we are seeing an outflow. What's your balance of payments estimate?
Again, at the current rate of oil prices, we would be kind of squaring in the second half of the year. And I think that's very positive because overall for the full year, if we just go a few months back, we were looking at about $65 billion of deficit on the BOP, which currently is now expected to be about $30 to $35 billion, which is what we have already seen in H1, because second quarter was the worst that we have seen. And after that, I think things have just been improving. So from there onwards, we're looking at around $30 billion of deficit for the full year.
Okay. In the balance of payments, right?
Yeah, right.
Okay. Now, Mitul, coming to that, this balance of payments is a bit financing the current account deficit has also been a problem because we saw this wave of outflows of foreign investors, and then again, it came like a wave and now it's a trickle. What is your sense about this risk-off sentiment? Should India continue to worry about financing the current account deficit?
Well, I think in an environment where central banks are tightening policy and will continue to maintain high levels of interest rates through next year, as well as quantitative tightening, i.e. reduction of major central banks' balance sheets, it's not a great environment for countries with current account deficit. It makes it more challenging to finance these deficits. And I think that means that it makes it more challenging for the rupee to appreciate strongly into next year, even in a potentially weaker dollar environment. I think the reality is, though, we've had a very bad year for emerging markets in general, for capital flows, including for India. I think next year we will see some improvement because a lot of funds are underinvested in terms of equities and bonds in emerging markets. So we expect some return. But again, I still think it's going to be a tough environment. It's going to be quite challenging. And in that sense, it's certainly not going to be a one-way bet for currencies against the dollar and for markets in general, even if foreigners return back to stronger investment flows next year.
1 minute. You gave me a couple of ideas. If you can tell me what your estimates are. You're saying even in a situation of weak dollar, we may have weak flows into emerging markets. So you think dollar's peaked off, the DXY doesn't go back to above 110 levels? What would your range be, say, for the next quarter?
Look, I think from DXY, we think we've probably hit the peak already. And I think it's not going to be a one-way decline for the dollar index. We will probably see a move below 100 as we go into through Q1 and into the second quarter. But I think it's going to be very jagged in our view. And again, we've seen this in the last year where every time investors have tried to write the dollar off, it's bounced back. And you've ended up with a more hawkish Fed supporting the dollar. This time round, the pullback in the dollar looks pretty significant. Positioning has been pulled back very sharply. But again, I would still argue that you've got to be very wary of bouts of dollar strength in environments of risk aversion, which I think will still be the case as we go through the early part of next year.
So what's your rupee range? Do you think 83 is toppish? As in toppish for the dollar, and the lower range, the lower part of the range?
Right. Look, I think 83 is a short-term top for dollar INR. I don't think we will see that break in a very, very near term. But look, I think I still hold a relatively more negative view in the sense as we go into next year. We would expect dollar rupee to be above 84 as we go into Q1. We don't think that even in a dollar weaker environment, we'll see a strong rupee. And I think it will suit India's economy to have some competitiveness for exports, to have a relatively underperforming currency. And I think India can afford to do that if they want to attract capital flows. It will help fund the current account deficit to some extent, and also clearly help the exports front. So again, we would still look for some rupee underperformance, even if the fundamentals are showing improvement, as we earlier discussed.
Everybody in RBI will agree with you. But the moment a central bank says that we would like a weaker currency, the currency can go to 90. So that's why it's very difficult for a central bank to come out with that view that they would like a depreciating currency. But, two quick answers from both of you. Mitul, given the kind of hawkishness we've seen in global central banks, where do you see the RBI repo rate topping off? Is it already at 6.25, or does it go to 6.5, 6.75?
So we think 6.5, potentially 6.75. Our forecast currently is 6.5 for the rate, the terminal rate for RBI. We did see a relatively hawkish Governor Das at the last RBI press conference, and that said, that's now countered with a lower inflation reading. So it's weighing this up, but I think there's still more room for higher rates, and potentially at least 25, if not another 50 basis points.
Okay, Upasna, what about you? Yes, macros are good, but look at the global central banks and their fury.
Absolutely, Lata. So I think 6.5% is what we are going with for now. Clearly, the hawkishness bias will be maintained. They will continue to retain their focus on inflation, especially because core inflation remains sticky. But having said that, headline is their target. If food inflation remains well-behaved, they would be in a position to stay on a pause for a longer period of time, especially given that real rates are turning reasonably positive above 100 basis, which is what they have stated as their comfort zone. So I think all of this taken together, they would probably stay on a status quo at 6.5% for a pretty long time.
And Upasna, your dollar range, like Mitul, do you also see 84 possible?
Absolutely. I would entirely agree with what Mitul mentioned. Despite a dollar weakness, I do not really expect EM currencies to really benefit out of that, because there will be a whole lot of uncertainty still going ahead. And at the same time, just to mention on next year's BOP estimates, we do have a current account deficit 2.3%, which is approximately $88 to $90 billion. And to that extent, balance of payment will still remain marginally deficit. Of course, not as bad as what we've seen this year, but we still remain marginally on the deficit side. And in that environment, the quantitative tightness that is expected to be in play will probably weigh on the currency as well. But despite that, I think we will see some bouts of appreciation in between. So 79 to 84 is a broad range, but of course 84 is a possibility, and sooner rather than later.
Oh, okay. That's very important. Mitul, what about flows? There have lately been a lot of brokerages saying that the North Asian economies, China and economies more tied to China could see foreign flows, and that could be flows moving out of India. So do you think there could be a flows issue in India?
I'm not necessarily sure on that. I think the economies that will perform well next year, in our view, are those with more domestically orientated focus rather than trade orientated. So actually, even though China's economy may benefit from some opening up, although it's struggling a little bit at the moment, trade is weakening. Exports are under pressure, and external trade will continue to weaken. So the likes of Korea and Taiwan and China that are more trade orientated will probably struggle from a recovery perspective, whereas India, Indonesia, and some more domestically focused economies will probably do somewhat better. So in that sense, actually, we could see flows come back into India based on the improvement in the economic outlook that is likely in the next year or so.
Okay. Well, on that positive note, thank you very much, Mitul Kotecha and Upasna Bhardwaj, for kind of setting the stage as to how the early trends in 2023 may play out. We are likely to see more rupee depreciation, but that's not bothering our experts very much. Probably towards the end of the year, we might see the rupee even appreciating as the balance of payments decreases. But there is going to be pressure, both depreciation and for the Reserve Bank to raise rates. With that, we wrap up on Bazaar, and that's lots of trading ideas lined up for you on Chartbuster.